Hello and welcome to another Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com, and in this video I am going to take a look at how you can anticipate whether or not a market or the markets, the overall markets, are going to break out and continue to run, or they're going to roll over and just tank altogether. But before I get into that, if you're just finding us on YouTube, please make sure to subscribe to our channel. And if you'd like more videos and insights like this, make sure to check out marketgauge.com/tutorials. And follow us at MarketGauge on Twitter for even more updates. So today was just a perfect example. I'll make this video quick for you. It was just a perfect example of some of the tactics that we teach our day traders that are applicable to day trading as well as swing trading, because it enables you to time the market. So the SPYs are consolidating right underneath their 200-day moving average and over their 10-day moving average and over a negatively sloped 50-day moving average. But the big question here is this consolidation going to lead to a breakout to the upside, or is this the beginning of rolling over down to the downside? Now, one of the ways to figure this out and really time it right to the day is to first look at the charts the way I have them. I've got the SPYs in the upper left, the Qs in the upper right, diamonds in the lower left, IWMs in the lower right. And on a daily basis, you want to see everything doing the same thing, everybody moving in the same direction. On an intraday basis, you want to do the same thing. All right. Now, a really an effective way to do that is to use the 30-minute opening range. And I said today was a really good example of how to know whether or not today's the day it's going to break out or fail, because of the action we saw around the 30-minute opening range. Now, I don't have time to go into the details of all the methods of trading the opening range, but maybe I'll put a link on this page to a webinar or instructional if I can find one. But the essence of the 30-minute opening range is it's the high and the low of the first 30 minutes of trading. And there are certain patterns that you look for to know whether or not you should get into breakouts or buy against the low of that opening range. But even before you get into that, one of the powerful ways of using this is to just look at how the markets are trading relative to these levels. And that's what happened today. So as I pointed out, all four markets were up near the high end of multi-day consolidations. The Dow, the diamonds, actually broke out above those previous highs, and it broke out above its opening range high, which is this yellow, green line right here. Now, in general, when the market breaks above its opening range high, it means the bulls are in control. But you don't want to get sucked into a situation where the bulls are in control in the diamonds, but they're not in control in the other markets. Now, sometimes this is a little gray, but today there was not a lot of gray, and that's why it was such a great example. So the markets started off by each one of them breaking below their opening range low. Okay, so each one broke their opening range low. What they didn't all do is break below the previous day's low. Okay, now this is getting a little more detail than we need right now for the demonstration, but they didn't do that. So if you're a little more experienced with the opening range, you would look at the Dow breaking out to new highs after putting in an opening range reversal pattern, as we call it, as potentially being bullish. However, look at what happens to the other markets, and this is what you want to watch out for. Just like I said on the daily charts, you want to watch that all the markets are going in the same direction. So the SPYs were not really able to get back above their opening range low by very much. This is very common. Once you get back into the opening range, that should be support. All right. And the same thing happened in the Qs. It got back into the opening range, but didn't follow through. So the diamonds are making new highs, but the SPYs and the Qs are telling you, we're not coming. All right. Now, here's the clincher. The IWMs never get back above their opening range low. So when the IWMs are below their opening range low and the Qs are back into the opening range, SPYs barely into the opening range, and the diamonds above the opening range, up is not the primary direction. You don't want to follow the Dow in that case. And in fact, you want to be focused on whether or not the weakest index, both on the daily and now intraday, is able to get back and get into gear. And if it can't, then you don't want to get too excited on the long side. Right? So take this and then you can see what happens. IWMs start to head lower. The whole market makes a new push down from which it does not recover in the IWMs or the SPYs or the Dow or the Qs. Ends negatively. So in these choppy markets, watch what all four are doing. Use the opening range. This is just one way that we do it. So hope this helps. Keep an eye on the opening range, and it really should help you figure out whether you're swing trading or day trading, which days are likely to be trend days and which days are likely to be choppy days. Hope that helps, and I'll see you in the next video.